Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we going to talk about? Well, I have a mystery chart follow-up, and it's not a good one. You know me, I like to show the methodology, warts and all. I mean, I'd much rather show you the great stuff, but this week we had one that didn't work out so well, and there's been a few lately. Unfortunately, I'll have to keep them crying there. So we're going to focus on 10 things that you must know about crypto, and it's pretty much any other market for that matter. Housekeeping, I do take requests. By the way, while we're on housekeeping, I talk with the tech guy over at StockCharts.com, Zach, and he told me that we will be going live once again very, very soon, early next year. So stay tuned for that for this particular show. As far as shows are concerned, I do another show every Thursday night. I was just thinking right before we went live. I've been doing that for probably 30 years, or at least 25 of those years, 25 out of 30 years or so that I've been trading. And it's every Thursday night at 6 Central Time, DaveLandry.com/webinar to register. If there's something you want me to cover, either in this show or in that show, DaveLandry.com/contact. The Thursday shows are live now and have been forever. So you can come participate there live, ask questions, and would love to help you out. And if you send me the questions ahead of time, maybe I can put together something to help address those things. If you want the slides from this presentation and every other presentation that I've done, including many of the patterns and all three of my books in PDF format, limited access to the members area, and a bunch of other stuff, just go to DaveLandry.com/StockCharts and put your information in. All right, let's get through this mystery chart quick so we can get into the crux of what I want to talk about this week. So this was mentioned in the pitch. I was actually long this. It was a beautiful setup. In fact, almost textbook in nature. Nice little Landry light, nice uptrend. Pulls back, triggers an entry, and then stop is down here. Initial profit target is up here. And what happens? It fails miserably. But I got stopped out, lost a little money, wasn't happy about it, dropped an F-bomb, likely. But you have to remember, he who fights and runs away lives to fight another day. And as you'll see in a few minutes, as conditions begin to worsen, this was a crypto pair, you will find yourself taking less and less setups as you become more and more selective. So we'll get to that in just one second. So it happens, and it's spelled with a silent SH in case you were wondering. I'm not allowed to curse in this show, but I've yet to meet a trader who doesn't curse. I met one trader, I'm not going to say her name, but within the first 2 minutes, she dropped an F-bomb. I'm like, wow, you really do trade. Anyway, number one thing you need to know about crypto is don't confuse the issue with facts. One of my favorite sayings. Yeah, it's hard to wrap your head around bits and bytes as an asset. I almost laugh. I smile when I say an asset. Digital assets. Doesn't that sound stupid? Yeah, it does sound stupid. Now, don't go out of your way to trade truly a scam coin. You could actually create your own coin. I actually looked into doing it just for S&Gs, and I wasn't comfortable putting money up, not knowing where that money might go and how the process worked. But it's probably was an exercise of futility to waste that time. But you could create what's known as a scam coin and on your own. So there are plenty of these out there. Don't go out of your way to find and trade them. But as long as there's adequate volume for a pair, and it's a setup, of course, then by all means trade it. And if it's on one of the more major exchanges. Now, there's been some scam coins that everybody talks about. Squid Coin, for instance, or whatever. I never even heard of Squid Coin, and the scam happened without me, thank goodness. But scams do occur. Scams occurred, by the way, during the .com era, too. And I knew, I don't want to throw anybody on the bus because I'm not sure how much is public knowledge, but I knew a lady who worked for a hedge fund, and that guy was really bearish on a company that he was convinced was a scam. And guess what? It was a scam. However, he was wrong for a long, long, long time, and it definitely hurt his business. But anyway, don't go out of the way, trade something that's a scam. There might be some things out there that are scams, but as long as you're working hard to avoid them, you should be okay. Now, one thing I was thinking about before I went live is I should also preface that with I am not a financial advisor, And I'd be willing to bet if you talk to your financial advisor, he would tell you to steer clear of crypto. So there, I'm off the hook for that. Now, number 2, same as number 1, don't confuse the issue with facts. Now, this is kind of the flip side of number 1. If you start looking into these coins, you'll learn there are some use cases, and you'll learn some things like Ethereum is 100 times faster than Bitcoin. Oh, okay, so Ethereum is better than Bitcoin, right? If Bitcoin is good, then Ethereum is much better. Well, Solana is 4,000 times faster than Ethereum. I probably should say up to 4,000 times. And possibly 30 times faster than a Visa transaction, which is kind of hard to wrap your head around. Now, a couple other ones. Avalanche is pretty dang fast too, as is Polygon. And they're many, many, many times faster, hundreds of times faster, or thousands of times faster than Bitcoin. The other thing that I've seen some people do recently is, again, confuse the issue with facts with possible use case type of arguments. Well, Crypto.com bought Staples Center, so they're legit, and they're doing some things which is going to create demand for the coin. Jasmy, or Jasmy as some people call it, has been an accepted currency in Japan. You could actually pay for stuff with that in Japan, and I've seen a lot of other use case arguments for some of these things. So I just look at them as a market to trade. I don't try to dig too deep into what they do. If I do, or when I do, I should say, it tends to cloud my judgment a little bit. Number 3, the big boys, Bitcoin and Ethereum, could be bellwethers to watch. Notice Bitcoin was in a really great uptrend for a while. Lots of Landry light to the upside. And then lately, not so much. Now, I remember on Thanksgiving Day, and Bitcoin had already begun to crack at that point, but on Thanksgiving Day, I remember that day in particular because I'm out frying turkeys, and every now and then I'd come into the office, see how things were going. I hit 7 initial profit targets, which I'll discuss here in just 1 minute, on Thanksgiving Day. And that means the remainder position becomes what I call a free roll. And then since that time, I can't hit the side of the barn. And if you look at this chart, it's obviously has rolled over it here and not doing so hot. So the question I'm wondering is, can you just use Bitcoin and Ethereum as possible bellwethers to keep you out of trouble? I'd be willing to bet you're going to do a lot better in the markets when there's a lot of green in Bitcoin or Ethereum, and it's pretty much going straight up. All the other, let's call them altcoins, is another. They're also known by many who trade them as, let's say, it coins with a silent SH. It's actually spelled SHY. But anyway, you get the idea. If things are going up, then the altcoins will likely be going up too. And I remember once, many, many, many years ago, 20-something years ago, might have been 30-something years ago. Geez, I'm getting old. And I've told the story 1,000 times. I think it's in the Layman's Guide to Trading Stocks. If not, it should be. But I was pouring my heart out to some attendee at a traders conference. And back then I was attending them, not speaking at them. And anyways, he looked at me and he said, "Hey, let me get this right. You can't make any money." I'm like, "Yeah." He goes, "Have you applied to the S&P lately?" I'm like, "Well, yeah, every day." And the S&P has just been chopping back and forth, and actually was working its way lower a little bit, I believe, at the time. And it hit me like a ton of bricks. It's like, well, that's why I can't make any money. Now, one thing I've been kind of fascinated with lately, I know you probably want to party with me, is the 30 EMA and Landry light. And I think that might be your best friend when it comes to crypto. And as I've been saying in presentations lately, if you don't walk away with anything, then walk away with the fact that Landry light and the 30-day EMA might just be your best friend. And you can see here in Bitcoin, we had a lot of Landry light on this nice little uptrend that it was in. Went from 40-something to 60-something thousand. And of course, on the downside, we had lots and lots of red, meaning that the highs are less than the moving average. And I just really like the 30 EMA lately. The whole Landry light stemmed from an article I did in 1996. I think I wrote it in 95. And it was published in Stocks and Commodities magazine. That sort of launched my entire career. I ended up on the institutional side, and then ended up in retail, and then the whole time I've been a private trader. Actually was a registered CTA for a while during that entire period, or during some of that period, 14 years I believe, if memory serves. Anyway, the article talked about the lows being greater than moving average, and one of the guys who read it contacted me, and he dubbed it daylight because there's light between the bars and the moving average, and then it later morphed into Dave light, and now we call it Landry light. Thanks to some of my clients helped me name it. Now here's something that's pretty amazing, at least to me. I know you probably want to party with me. But this was done on Monday, and I probably could have done another 50, 100, or maybe even 500 charts that look a lot like this. And this is somewhat random crypto, but in somewhat alphabetical order too. And I just went to the ACP platform and pulled up crypto pairs and started tooling through them and grabbing a couple of screen grabs. Notice how many of these are headed lower. Notice the Landry light to the downside. Notice how they're below their 30 EMA. Well, there's nothing to do with these pairs, okay? Don't buy them because they are currently going down. Wait until at the least, I should say, they are above that 30 EMA. And I'd be willing to bet that works really well in stocks too. Number 5, the 3 most important things that you need to know about crypto. Obviously, this A does not belong there. Money management, number 1. Money management, number 2. And money management. Everybody's a setup junkie. I can show you some really simple stuff in crypto, really simple setups. You can learn in about 2 minutes. Sometimes when the market's doing really well, you just buy the ones that are going up, as I've been preaching and showing, especially in my StockCharts webinars live. In fact, a lot of times during those webinars, you'll see me stop and go and make a trade or two because things are going up and they look well, they look good. Now, if you're not in a rip-roaring uptrend, and right now, hint, hint, you saw that prior slide, right, with all that downside Landry light, then you probably want to sit on your hands a little bit. I'm going to talk a little bit about that in just 1 second. But money management is really important when it comes to crypto. So getting back to the crappy example I showed you earlier, unfortunately it didn't work out, but you need to see the good with the bad, right? Or the bad with the good, I should say. In a case like this, you get stopped out, you drop an F-bomb, and you move on. Now, my money management in general for crypto, it's very similar to stocks, but in one way it's a little different in that I'm looking for just a fixed IPT of 20% because they're so dang volatile. Most of them, with the exception of some of the much higher priced ones, maybe something like Solana, maybe use 10% on that. And by the way, in stocks, I adjust to the volatility of the stock. There's not a fixed point stop or a fixed percentage stop. I think you can get into a lot of trouble if you're using fixed percentages when it comes to stops. There was a popular methodology, as I've said ad nauseum, that said on every stock you should risk 8%. Well, some of the stocks we trade might trade 8% in 10 or 20 minutes. So you need a much wider stop than that. You have to adjust to the volatility. So saying that you should risk 8% on every stock, if stopped out, is like saying we should all wear a medium-sized shirt, something, as I often say, my fat arse hasn't done since I was 5 years old. Anyway, in crypto, again, I've been using just 20% for the most part because they're pretty volatile. My stop, I try to keep it a little bit less than 20%. Now in stocks, if we're risking 2 points, or let's say that's 10%, then my stop is at 10%, okay? In crypto, especially on these breakouts, I'm using a much, much tighter stop. But in general, I want that to be 1 to 1 or less than 1 to 1 to my IPT. Now, we trail a trailing stop, and if this doesn't make a lot of sense to you, we've done shows on money management and I have a complete course on money management. And just make sure you don't operate heavy machinery after viewing and watching. But here's the thing. As I just implied, money management, money management, money management. This is 10 times more important than anything else that I can tell you about trading in general and about trading crypto. Now, for the most part, we have a one-to-one trailing stop. So if this goes up 1 point, our stop goes up 1 point, okay? And we only tighten stops. We never loosen them. And once you hit that IPT, your stop is immediately moved to break even, okay? And then we allow that to loosen over time. Now, without getting into a lot of details, the secret sauce in all of this is allowing that stop to gradually loosen up over time, and that helps you to adjust to the longer term volatility of the market. So we start out as a swing trader and we work our way into longer term trades. In fact, we've got some in the portfolio, knock on wood, let's hope they stay there, but we've been in for 460 something days. So we've been in those positions for a long, long time, and it all started with a swing trade. And as you can see right here, this was a nice little pullback. This is one I've been showing quite a bit. It didn't quite kiss the EMA, but it was a nice pullback. I took it. I thought it was pretty good. And then 2 days later, luckily, I was able to sell out for a 20% gain, and then I trailed the stop higher. And my trailing stop's not in here, but it would look a lot like the EMA if you were to look at it. When I start plotting my trailing stops on a chart, they begin to look like a moving average. So you could use a 30 EMA if the pair is not stretched too far away from it as at least a reference point for where your stop should be. And as I said last week, I got stopped out and I went right back in. Now, here's the cool thing, is the core methodology, meaning mostly pullbacks in nature, and selective breakouts. If everything is really blowing and going, then sometimes you could just buy the strongest ones. Again, go in and watch as many weekly charts as you could stand for more on that. Now, here's the thing. All methodologies and all setups tend to kind of look the same. I'd love to tell you that I have the best setups out there. It's taken me a long time to decide on what is the best, and I think mine are the best. But what you're going to find is a lot of methodologies, trend following, for instance, they're all going to have the same nuances, and they're all going to look pretty much the same. Now, 95% of what I do is probably just pullbacks, occasionally breakouts in an inefficient market such as IPOs, as I preach, and crypto. At least crypto was wildly inefficient a while back. I guess it still is, but now the inefficiency is to the downside. Or any other conceptually correct methodology can work really well. As long as you're trading with the trend, looking for some sort of correction or some sort of breakout or acceleration in that trend when things are going really well, you're going to find that it works really well in crypto. Now remember, you're trading traders and not markets. And that's hard to wrap your head around when you first get into trading. You might look into fundamentals, or you might, if you're looking at crypto, you might say, well, they're just stupid. Or if you think, well, wait a minute, maybe there's some use cases or whatever, you start confusing the issue with facts. And you can never lose sight of the fact that you're trading traders and not markets. And keep in mind that human nature does not change with the market. Everyone is motivated by fear and greed. Now, bubbles are your best friend. Now, the bubble may have burst here in crypto, but that's okay. As you'll see in 1 minute, if we're patient, we might be able to play this market once again. And just keep in mind, everybody's motivated by fear and greed. There's a book called Devil Take the Hindmost. It's a pretty good read. I haven't made it all the way through. It's not the most exciting book in the world, and my apologies to the author. But he goes into a lot of details about what happened in all these bubbles. And the gist of it is, or at least my takeaway is, these bubbles didn't occur and then overnight they were done. They lasted a long, long time, and a lot of people made a lot of money along the way. Now, eventually, people got caught holding the bag. Same thing happened in the NASDAQ. And as I've been preaching lately, it went up 400%, and then it lost 77% of its value. And those people who confuse the issue with facts, it didn't embrace and accept the fact that it's fear and greed, and that's pretty much it, okay? Missed the boat on that entire run. Now, as I've been preaching ad nauseum, just like any other market, all you need is for some greater fools to come along after you enter, okay? So as long as greater fools come along, and that pair, for the most part, and I'm beginning to adjust my volatility a little bit more lately, but in general, for the most part, 20% is a good round number. As long as some greater fools come along and push that market up 20%, then I can get my initial profit target and I could put my stop, or move my stop, I should say, to break even, and then I can hopefully ride that pair for a long, long time. Number 9 is patience. And patience is the secret to crypto and any other market. As I just showed you, now's not the greatest time to be trading crypto. Well, you need to know from me, not only when things are good, but I think it's important for me to tell you when things aren't that good. And right now is the time to maybe sharpen your axe a little bit, get educated, and then wait for the markets to start moving again. By the way, the reason a methodology works, such as trend following, is because sometimes it don't, okay? Sometimes it doesn't work. And I think that people go off to chase rainbows during those periods, and eventually the trend following starts working again nicely. So wait for your pitch. And there's a lot of psychology about waiting for your pitch and why it's hard. And if you go in and watch prior presentations, you'll learn a lot about that. The bottom line is the real world does not train us to be patient in so many ways, especially if you are very career-oriented and have a career such as an automatic transmission mechanic, a doctor, or if you're a lawyer, or in the case that I'm alluding to, a psychiatrist. You can't sit around and wait for the ideal client to come along. You have to take whatever train wreck, and this is quoting a psychiatrist who's a client of mine, explain to me why the successful people are not patient and can't wait for their own pitch. And of course, society does this to us too. We live in this so-called microwave society. I just built a new house. We didn't really put a lot of effort into our appliances other than the refrigerator and the stove. We just got whatever else they put in the house. And our microwave is slow, and it aggravates the hell out of me. I know. First world problems, right? Anyway, we are trained to not be patient, either through the world or our careers. The other thing I was thinking about with patience is figure out intuition from intuition, and that's a Sakota comment. And I always say I'm going to do a presentation and not say that. That's nearly impossible for me, and you own the world. So good luck with that. Figure that out, write me a letter. But you can go a long ways to doing those things if you're just trading a few simple patterns, one simple pattern to get started, right, until you're successful. If you're not successful with one pattern, you won't be successful with a dozen. I can guarantee you that. With, of course, a heavy dose of money management, planning to trade, and trading to plan, you'll begin to do fine. But you will reach a point where your ego will rear its ugly head, and it could be like after a drawdown, like we've had lately, where you just really looking to find that next market that's going to pull you out the drawdown and certainly help pull you out the drawdown. And sometimes you can end up into wishing as opposed to using your intuition. And as I just kind of alluded to there, it's all in your head. One thing I've been talking about a lot lately is being cognizant of your own emotional behavior that has nothing to do with the underlying markets will help you wrap your head around the emotional and irrational nature of others and the market itself. And I've had a lot to say about that in prior weeks, and in coming weeks I will continue along this theme, especially as it relates to trading psychology. Now, by the way, talking about emotions here, it's been proven that you cannot make a decision, any decision, without emotions. And without going into a lot of detail on that, they've taken people who were very unfortunate through illness or injury and had the emotional part of their brain pretty much annihilated, and they cannot make any decision because there's no emotion or decisions attached to that. It's interesting. I used to have a book fetish where I would just buy tons and tons of books. My wife would get mad at me when it was time to move a while back when books were still coming in. But one of them that I haven't read it or hadn't finished and just finished recently was SFO Personal Investor Series, Psychology of Trading. It's a pretty good read. And the author is Sether, S-E-T-H-E-R. But it's quite a few different people in here. Anyway, one of the things they talked about is they did experiments on people that did have partial emotional brain damage, and they actually made for better traders, which kind of confuses the thing I'm talking about here. But what happened was the damage was such that they weren't overly emotional in their trading. So remember, you can't make any trade without emotions, and that's why you have to be cognizant of them and embrace them, and that helps you, again, to understand the markets. But on the flip side, if you're kind of slightly brain damaged, you might actually become a better trader. That's kind of a bit of a fun fact there. Well, that's all my time for this week. I appreciate you watching this so much. Again, if you want the slides of this presentation and all the other presentations, DaveLandry.com/StockCharts. If you need to reach me, DaveLandry.com/contact. Thanks for watching again, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.